same with like the SBA or whatnot, right? Like the government's like guaranteeing certain things, right? Creating like a pool of money and saying, hey, we'll guarantee this stuff, but you go lend on it, right?
Interest rates so much, right? Because interest rates and debt fuel our economy. They fuel the world's economy, really. But I mean, the United States is very good at using debt to grow. And there's a big reason why the United States has grown so much.
What's great about apartment buildings is you get 30-year fixed debt,
Mhm.
right? Which is fantastic. You lock in that 30-year fixed debt at 4.5%, and real inflation, let's say, is like 5, 6, 7%, right?
The big players understand debt, right? And if you know what the most sophisticated people are doing, there's a reason why they're doing it because they understand the tool that debt is and how to wield it, right?
Welcome to the Wealth Strategy Session.
This is where we unpack one key wealth building strategy at a time and show you how to apply it.
We have a great wealth strategy session today on who gets money first. With me today is the Sultan of Smart Money, Dr. Reed Faldette. Reed, how we doing this Friday?
We're doing good. We're doing good. I just got notice that we closed on our 40 unit, so got that done. So that'll be exciting. We can maybe talk about that on another show. But I thought maybe we could sometime dig into the numbers and underwriting and you can give your assessment. You'll have to be nice because
Awesome.
we closed on it, so you have to keep that in mind. You're not trying to talk me out of the deal that we already
Oh my
closed.
gosh, I can't believe you bought this. No,
You
dude,
are an
that's
idiot. Yeah.
no, that'll be super fun, man. I love to do that. We are up at the ski condo today. There's not been a lot of snow in the western U.S. this year. It's been fine. We've been making it work, but we are getting dumped on this weekend. So super excited to take the kids out after this and hit some fresh powder. So it'll be fun. Okay, Reed. With our topic, very cool topic. Who gets money first? Who are we trying to help today, and what problem are we trying to solve?
Yeah, I think we're always trying to look at, or you and I often look at the macro and then see if we can apply it to the micro. Like it's interesting to listen to politics, geopolitics, and economic forecasting and kind of see where we are in cycles. But more importantly, how do we like take that information and possibly apply it or put us in a strategic position that we can benefit from it? So I
Yep.
think that's kind of how we look at this. And I was listening to a podcast where this kind of came up, and I was like, we should do a show on this because it's fascinating to me, and I think we are both poised to take advantage of this, but also maybe help other people think how we're kind of strategizing right now. So,
Yep. Yep.
can you
So
see
those of you
this?
watching on YouTube, you'll be able to see this. Those of you listening, we will briefly describe it. But Reed has a diagram here entitled "Who Gets Money First?" And it talks about when the Fed creates money, what is the waterfall system through which that money falls, right? And so, Reed, you want to kind of walk people through the levels for the listeners who can't see the diagram? Um, just kind of
Yeah,
overview it real quick.
yeah. So just kind of starting at the beginning, think about it as, and let me pull this up too, so I have this kind of in the background, so I have my notes if I need them. But basically, anytime we often talk about interest rates so much, right? Because interest rates and debt fuel our economy. They fuel the world's economy, really. But I mean, the United States is very good at using debt to grow, and is a big reason why the United States has grown so much. Our whole economy is propped up by debt. So when we talk about interest rates, that's such an important part to everyone's life. Whether you're an investor, whether you're a consumer, it doesn't matter. It affects you. So when we're looking at this and we're talking about who gets the money first, we're referring to when the Fed creates money and how it flows into the system, how it goes all the way through from the top to the bottom. And
Yep.
so simply put, I'll kind of outline this. We can talk a little bit about how this specifically happens. But essentially, when the Fed prints money, they're saying that now we have this much money on our balance sheet. So that shows up as a big number in the Fed Reserve. From there, a simple way this gets into the system is it basically allows banks to borrow from that. So now banks have more money or more liquidity to lend into the system. And so this is showing how it starts there, right? Banks and financial institutions, That's where the money typically goes first. Then from there, it's typically large corporations and government contractors. And this is in large part just due to access. I mean, they're whoever the biggest consumer is typically gets access to whatever that thing is first, right? And so
Yeah.
large corporations, government contractors are massive consumers of debt, right? And so they're often going to get it first. Corporate
And,
bonds. Yeah, go ahead.
yep. Yeah, they're the first layer, right? Like if I'm even if I'm borrowing um you know, from let's say, like at the consumer level, we don't get to borrow directly from the Fed, right? We don't borrow directly. The when I go to a bank to get a commercial loan, right? They're borrowing from the Fed, like the FHLB, right? They're looking at these numbers and they're saying, okay, we can borrow at this, Josh. We're going to add our spread to that and lend to you, right? So they're the ones borrowing directly. Um, y- same with like the SBA or whatnot, right? Like the government's like guaranteeing certain things, right? Creating like a pool of money and saying, "Hey, we'll guarantee this stuff, but you go lend on it." Right? And so yeah, we're not first in line to the food line, right?
Yeah.
We there's a middleman kind of, and so what you're saying on level one, level two, these are like the people who are first in line, and then they allocate those funds to to others.
And if we think about a few weeks ago, we were talking about, um, I think Trump's mandate to try to help with housing and Freddie Fannie agency. They were talking about the Fed. I think they're talking about the Fed purchasing security-backed mortgages, right? So that
Yep.
that would help with liquidity. That would then help be lent out, which could help make more competitive lending environment, right? And maybe drive interest rates down. I mean, the mechanism a little bit eludes me, but I think that was a conversation a few weeks ago. I don't know if that happened at all, but
Yeah, I haven't seen the follow-up on that either, but yes, it's yeah, so these first level one, banks and financial institutions, they get the access to capital and then they lend it to others, and then large corporations, government, they get access to this capital second, and when these two levels go out and start buying things, right? uh, Demand goes up, prices go up, right? And I think the real key point here is just the way our system is built with how the government this the pure structure. If prices go up and we as consumers haven't seen the money yet, we're second to the table, right? We're not
Mhm.
buying at the lowest price. Someone else had a chance with all this fresh new money to go buy first, and then we have the opportunity to get money second, but prices
Mhm.
have already gone up. So do you want to flesh that out a little more?
Yeah, yeah. I mean, I think you could, again, you can think about this like, well, it's one way to think about it is if there's buying power, right? Anytime, again, consuming more, you have buying power. So even think of like a large DSO and what they can negotiate with
Yeah.
suppliers, right? And
Yep.
equipment companies versus like the single dental owner operator, right? There's just,
Yep.
when you have that, you have quick access to those things and you can get them at lower prices. So not only do they get access to the debt first, but they also get access to usually better debt with lower rates, which again allows them to enter the market and be more aggressive on whatever it is they're buying. So,
I I like that analogy. Yeah. So the DSO is going to go buy 10,000 units of this cement, right? With this fresh debt. And then after those 10,000, the order's been put in, the manufacturer's like, wow, these guys are buying 10,000. We don't have any extra inventory, so we don't need to lower our prices, right? We can probably raise our prices a little bit because we don't have any inventory sitting around. And now we come to them and say, hey, we'd like to buy some cement, and
we'll take
we're not
five.
getting a deal, right?
Yeah.
They're not getting a deal.
Yep.
So, yeah.
Yeah. That's a good way to think about it. So basically, how in this flow of money do you poise and position yourself to take advantage when interest rates go down. That's something we want to talk about. But do you want to talk about something else first?
I just like to talk about the same example with like real estate, right? So, when all this money comes out, we know that asset prices have dropped in many asset classes, especially office, right? But
Yep.
even if they haven't dropped, when you stay steady for 2 years, but inflation's gone up, let's say 5, 7% a year, then, relative to inflation, the prices have actually dropped, even if the price is the same it was 2 years ago, right?
Yep.
So these corporate, these real estate investment trusts, the REITs, the hedge funds, they understand that, right? They understand that prices are 14% down, even if they don't look like they're down, right? Or in the asset classes, but they are down, 15, 20%. They're like, wow, they're actually down 25%, right? And so they get this flesh slug of debt from the government. They're going to go make offers on these large apartment buildings, these shopping centers. They're going to go make offers and try to buy this stuff, right?
Hmm.
And and when they do that, when you and me, like it trickles down from these big institutions, and then now my local bank has a little bit more money to lend, and I'm talking to my banker, and they're like, yeah, our allocations are full this year, right? Oh, we're not really lending much, and but now, like, it's 2026, and they're like, hey, yeah, the bank's wanting to lend a little more this year. We've got some allocation available. I go and look for shopping centers, and now I'm dealing with these institutions that already have been like, bidding and putting these things under contract for 3 months, right? And
Hmm.
so I'm second to the table, and I'm not getting my debt at the same price that these guys are getting their debt, right? So A, they're first movers. B, their cost of capital is lower than mine. I'm just not going to be competitive, right?
Hmm.
And so it's just we want people to understand that like when you're looking online for deals, is super hard to find because anything that these larger institutions are looking at, they have that first mover advantage and they have the lower cost of capital advantage, right? So that's why it's a challenge. So that's why we source deals typically through our network. We source deals offline, like because then we're not having competition, right? Or we're in asset classes where the big people don't play, right? If all the big players are
Yes.
playing at 50 million and up projects, right? Um, I'm not trying to buy a $50 million project because I'm competing against them, but I might sell. I might build a $50 million project because I know there's a ton of like institutional capital out there looking for $50 million projects, right? So,
Hmm.
so the key is here is don't try to compete with these big guys, right? Find out what they're not interested in right now. We had an office complex, a government occupied office complex that I've mentioned, a year and a half ago that looked super attractive because it was like 50 million bucks and nobody was buying office at 50 million bucks, especially it was a tier three market, like a smaller market, right? This one was near Hanford. Um, and so we didn't have any competition, so we were really setting the price. It was a really good deal. So yeah, I think that's the key point here, for
Uh,
people to understand. And then also as a consumer, the other thing to understand is just general goods, right? Like gasoline. Like these guys are buying their gasoline with this debt, and then we're buying the gasoline at the pump a couple of months later, right? And so unless there's a large supply of gasoline at that time, we might be paying higher prices than these guys, like I'm sure we are, right? So just understand that this is how things are set up. But then the key piece here, we always want to talk about, okay, here's the macro trend. How do we leverage this trend for ourselves personally? So you want to go to the next slide, Reed, and we kind of touch on that?
Yeah, yeah, I will. And I just wanted to wrap one point that you said because
Okay.
the whole yes, you don't have a competitive advantage against these large institutions with a lot more money because their cost of capital is lower, their access to resources is greater, etc. But one thing you can exploit is, like you said, Josh, is if you know that you can sell or you can develop something that they'll want to buy later, then you have a cap rate arbitrage potentially. Like anytime you can right, create value or even aggregate assets where it's attractive to the institutional buyer, then typically you can shift your cap rate lower and get a better return. And this is what people do with roll-ups all the time. So not to say that like the average dentist is going to do this unless if they're building a DSO or something like that, and then they're gonna sell it to somebody else. But I've seen this with different operators I know that do different asset classes is they're like, we're just going to get to that point where we roll up to the next level and then we can sell to a REIT or sell to the next big
Yeah.
buyer.
It-
And
and this typically works with Class A assets, maybe Class B, right? Just
so,
in general. Like you're topping a strip center, right? Like these big guys want to buy bigger, larger Class A strip centers typically, right?
mhm,
Apartments, bigger, larger Class A apartments, like 75 million and up, right? It's return on time for them, right? They don't want to buy
yes.
the small stuff. And so when you choose your strategy for investing, if you're choosing like an equity growth, a net worth growth strategy, these Class A assets selling to these guys totally works, right?
Mhm.
If you're choosing like a cash flow strategy, typically you're playing in like the B2C pool on
Yep.
assets, right? Because these guys aren't playing there. There's more opportunity, there's more hair on deals, problems that you got to solve, right? There's less. The coupon clipper 1031 buyers are typically not buying the BCs as well, right? They want that Chipotle, uh, credit union type tenant, large medical type tenant, right, to lower their risk. So it's really like what strategy are you trying to utilize, right?
Yep.
Develop and sell to institutions, make a lot of money on the arbitrage of the price, or solve problems in the B2C range, cash flow,
Cash flow.
harvest
Yep.
as you go. Two great
Yep.
strategies.
Yep.
Cool.
Yep. Cool. Okay. So moving on to this. So we were talking about the Fed printing money and trying to make money cheaper, right? So just think of if you think of money as like a consumer good, typically consumption goes up when prices go down, right? That's kind of how you think about it. Debt is really that's what it is. The lower the cost of the interest rates, the lower the cost of the money or the cost to borrow, and obviously there's going to be more demand for it. So again, more people borrow money, so because excuse me, rates lower, that gets cheaper, right? So more people borrow money, and therefore asset prices go higher because there's more
Yep.
demand for those assets. Now, the interest we already were kind of talking about that in the prior steps, but the interesting thing to think about here is that inflation destroys debt over time. And so I think this is kind of a fascinating topic. And it took me, it was actually my early investing days that somebody had explained this to me and it made sense. So I'll try to explain it now. But basically, if interest rates are 3 or 4%, we'll just say even 5%, but inflation is 7%, 8%, 9%, right? Essentially, the cost of capital is negative because you're almost like you're getting paid to borrow money because
Yep.
you're borrowing something at today's dollars and paying it back at tomorrow's dollars, right? So if you can fix your debt today, or even have for the next 5 years, where inflation is 7, 9%, but you're paying 3 or 4%, right? There's an arbitrage there to be had. So
100%. And I think the classic example that I always think of that almost nobody has this, but let's say you're a trust fund baby, right? And you're going to get $10 million every 5 years, okay, for the next 15 years. So three slugs of $10 million. So always the way I think about that is, take that $10 million, buy newer apartment buildings, right? What's great about apartment buildings is you get 30-year fixed debt,
mhm,
right? Which is fantastic. You lock in that 30-year fixed debt at 4.5%, and real inflation, let's say, is like 5, 6, 7%, right? So on top of all the returns you're getting, disinflation and debt difference, like you're talking about, is just paying you money, right? And the hard part is most people, they need to make money as they go, right? And so you typically don't see this like long-term patient strategy. But if you have huge slugs of money, I mean, you just run the math on this and you make a ton of money with your 10 million bucks, right? It's just a great long-term patient strategy as long and it works as long as populations stay stable in that area, right? So your rents slowly increase, or population grows a little bit. And two, inflation occurs, right? And if you look at the history of the world, populations go up and inflation is predictable, right? So it's a great long-term strategy to grow wealth, if you can do it.
And the risk of inflation on that, like if you're owning that asset and there's inflation, right? Again, you're getting help on the debt side because you fixed it. You fixed rate
Yep,
debt for a long
you
period of
fixed it.
time. But two, if even if your expenses are going up with inflation, your rents are going up as well, or maybe even disproportionately so. So you have such a good hedge.
More.
More, yes.
Typically double, right? Your rents are going, your revenue is typically two-thirds and your debt's typically one-third or one
Yeah.
quarter, right? Or one-fifth.
Mhm.
So yeah, like if you have fixed debt in and rents go up with inflation, right? They're not like fixed
Rent
artificially.
control.
Yeah, then it's just great.
Mhm.
It's
The-
just yeah,
So,
autopilot.
so yeah, so that'll be kind of this next part we'll talk about a little bit is I think what we're trying to get at here is the big players understand debt, right? And if you know what the most sophisticated people are doing, there's a reason why they're doing it because they understand the tool that debt is and how to wield it, right? And so when you first learn about debt, everyone gets kind of scared by it. And you should, to a certain extent, be scared of debt because when it's used incorrectly, right, you can go bankrupt, right? It can cause lots of problems, especially on the consumer side. But when you look at it as a tool to get better yield, right, and to build your wealth, like then you start thinking about it differently. So if we have if we're making the case that debt when used well, right, is such a powerful thing and all the big players use it, then how do we mitigate the risk associated with debt? That's kind of what this next part is talking about.
Mm,
So so basically, if you know whatever you're borrowing, if you know that there's an asset that you're buying, it's producing a certain amount of cash flow to service the debt. The biggest risk is that cash flow goes negative and that you have a debt service payment that you have to cover.
yep,
So,
yep,
right? So one, you mitigate that by buying right, operating right, having control, etc. But just thinking of it as a personal layer, we do this when we look at this different layers here, it's going to represent different layers of liquidity, right? Access to
yep,
capital.
yep,
So, so you can do this. Sometimes we silo this in specific deals, right? I think about this as a specific deal. Sometimes I think of it as like my global, like financial picture, across all my assets. And sometimes I think about it just within my dental offices as well. So you can silo this or you can think about it globally, but here's how we think about it. Layer one of liquidity is an operating buffer. So this means money that you can access today, right? This is usually cash in the bank. So usually you need 1 to 3 months, whether it's in a property, whether it's in your operating business, whether it's in your personal life. That's kind of a good rule of thumb. Any pushback on that, Josh? Or do you want me to go through it all and then you can tell
Go
me?
through it all. Yep.
Okay,
I don't want to
okay.
interrupt you.
Okay. Layer two is emergency reserve. So this is 3 to 12 months of reserves for, again, either personal or for the specific business or property. Now this you could probably, to a certain degree, have in more like CDs, money market accounts, high yields, things that are maybe not as easily accessible, but you can get to the money within, call it a week or so, right? If you need to. Layer three is asset-backed liquidity. So this is borrowing capacity against assets. So this is, let's say I have $1 million stock portfolio and I have a securities backed line of credit that I can draw from. So basically the stock is the collateral, the liquidity comes from borrowing against it. Or a HELOC on your home, right? So your asset, your home, right, is the collateral, but I can borrow against it if I need to, right? So that's another form of liquidity from that asset. Or it could be from your dental practice, or it could be from a property that you have a lot of equity in. So basically, it's creating liquidity by possibly borrowing against the asset. So that's kind of layer three if you really need it. So how you think about it is I have a problem, right, that money can solve. Hopefully layer one takes care of it. Maybe you have to go to layer two, but if you need to go to layer three, you have that available. So I have a line of credit against my dental office, my home, but I don't draw on them unless I absolutely need them, but they're there and available. And then layer four is really just this is basically like the majority of your net worth is going to be in these assets, right? Whatever real estate, stocks, whatever you choose, Bitcoin. And so basically the goal is to have enough that you can borrow against if you need to, and that you never have to liquidate, unless if you want to. But you never want to be forced to
Yeah.
liquidate.
This is a really good slide. What my mind goes to immediately here is you think about all like the wealthy guys, buying places in Florida right now, right? Because they're moving out of California to the wealth tax, right? The billionaire tax. They're like, I'm out. So we're moving to Florida. Um, those guys are buying like 50 to $100 million properties, right? And these guys are billionaires, so they could pay them in cash. But most don't, right? Most instead get loans on it because the math just makes sense, right? That's one. But two, they have these buffers in place, and so it's not stressful for them, right? You hear a lot of dentists say, "Hey, I just like to pay for everything in cash," right? Like, why do they say that? The math doesn't say that, right? They just don't want to get themselves in trouble, right? They don't want to get in a situation when they're in trouble. It stresses them. It's like having a monkey on their back, right? This
Mhm.
debt. And so they want that feeling of freedom, but like the math says don't do that, but they do it, right? So when you think about if dentists are going in cash, some of them, let's say half of them just like to operate in cash, not have debt, but the really wealthy and smart guys are doing debt, it's like, what's the difference? Well, the difference is here in this thing. So, dentists will typically have an operating buffer, right, in their business. Well, these entrepreneurs, right, with these large tech companies, um, emergency reserves, they may have those, the tech guys. But what the tech guys, always have is this stock, right? They own a large share of this company of theirs, right? And they can borrow against that. So, that is their buffer that makes them feel comfortable, right? They may not keep a lot of liquidity, but they know they can borrow against their stock and their business,
Yep.
and so they can bail themselves out if they get into trouble on something. So I think that's like the big piece here. Um, and you know, getting like reality, like emotion is like a big reality here for folks, and it is for me too. So I just want people to understand like it's normal to have a lot of emotions about this, and you have to balance like the numbers in your plan with like the emotion and the stress it causes you to have debt, right? And these are the tools Reed and I use to like mitigate that stress so we can sleep at night, right? There is an operating buffer every year that's different that I just feel comfortable with, right? Let's say how much money I like to have in my, personal bank accounts, how much money I like to have in my business bank accounts. And, if I don't have enough, I stress. Um, and two, it's harder for me to get bank loans, right? Because I don't have enough cash. And if I have too much, I stress just because of inflation. It drives me bananas to see a bunch of cash sitting there not invested, right? So there's this sweet spot where, you know, the pain of not having your money invested and earning a return and having inflation burn it away versus the pain of like, oh, what if I don't have enough cash, right? Those two pieces of pain have a middle point, right? So you try to find that middle point for yourself. And so when people ask, how much cash should I have, right? That is the answer. Find the pain between those 2 points and find the middle where each of those pain is minimized. Um, I know I didn't say that the most concisely, but that's how I look at it. How do you look at it?
Yeah, so I think this pyramid here, what it's showing too is if you know whatever you need for liquidity, right, to feel good, the balance there is having again different layers of liquidity. So like your top layer of reserves is not going to earn any yield for you, and you have to just be
Yep,
okay with that, right? And that's
yep,
that's we find what that number is, right? And then layer
Yep.
two is the next part of that where you're going to get a yield on your liquidity, right? But you don't have quite as much access to it. But that's okay. But you're still having this like blended yield on your liquidity. Like then I
Yep.
consider my stock portfolio a lot of my liquidity because I want to get a decent yield on it, but I don't need it in short term, right? So that's I think I've really evolved like my views on liquidity because as the portfolio has grown, right? As the debt has grown, I've just ratcheted up my liquidity because it, again, for peace of mind, because that's more important. But then I think more strategically on how I utilize that liquidity to still get some yield. So I've just spent more time thinking
Yeah.
about that over the last couple of years.
So the way I look at this too, and I'll like personally how I build it. I mean, we talked about like the cash flow accounts you mentioned maybe 2 months ago, kind of how you structure it. Kind of how I structure this is like operational buffer. I have a bunch of LLCs for like a real estate LLC or something, right? I don't keep a ton in there because there's only like, one check going in and one check going out a month on average, right? It's not a ton, right? So maybe I'll keep like 10, 20K in there so I just never have to look at it, right? I don't have to worry that
Yes,
we're going to overdraw or something. So
100%.
a bunch of those accounts. But then I have like um, but then I have like a large personal account because you don't want to commingle between businesses, real estate entities, businesses. So I have like a large personal account that I get money from my businesses go into, right? And then I also spend money, right? Like if I want to contribute capital to a new real estate investment, right? Or pay for development costs, I contribute or lend capital to these different LLCs, right? So I have one account, and the key things for me that with that account are two things. One is a little higher rate of return, right? So that's like the 3% or something, 3.5%. I want that out of that account. And then I want to be able to send super easy wires, right? In
Mhm.
ACH transfers, right? I don't want to be on the phone with the bank for a half an hour every time I need to send a wire, right? That's super annoying and a waste of my time. So I have this large cash account. You know,
Do you
the
see my money flow diagram? Can you see it?
Yep, yep,
Okay,
yep.
okay.
So this is the
So,
one we were talking about before. So this is your personal high yield savings, right?
yep,
That's probably the equivalent that,
yep,
that I have. So the best one I found for this is it's called a Fidelity cash management account, Fidelity CMA. And what I like about that is like the wires are free. I can do them online, and I'm earning whatever 3.5%, right?
yep.
I just couldn't find other personal business. Yes, there's lots of business options that do that, but when I say a lot, maybe like five, but on personal, I just almost never see that. So I use Fidelity for that, and then for my business stuff, same thing. I have all my business accounts with meow.com. It's just super easy to transfer money. It's super clean. Their software is great. So I can wire money, I can ACH money, just like lickety split. And then they also have these um different like yield options, 3.5, 4%. You just push a button, the money gets transferred to a CD, right? If I want the money back, it takes like a week, right? But it's just click of button ease. Um and
Ease of use is so important when you're doing this all the time. I mean, if you have any
e
resistance, right, or
oh
barrier that just it just wears you out. So even I'll
yeah.
take a little bit lower yield if everything is really easy on,
Oh,
yeah. Just
absolutely, absolutely.
yeah.
So I think you're looking at your model here, for instance. We're talking about like, I'll just from my perspective, but like real estate aggregate account 50K, right? It's the same thing. You don't have a lot of things happening there, right? You have debt coming out your debt payment coming out, and you have your rent payments coming in, right? And every once in a while there's a little extra from something, right? But it's pretty predictable, right?
Mhm.
There's not major swings that happen here, so you don't need to keep a lot of cash in there, right?
Correct.
Um, Same thing with your primary operations of the dental business, right? You're gonna have little swings a month, one month's better than other, but it's not. You you just a little buffer and you're good, right? Um, and then if you ever need to buy more equipment for your office, you can either do it in cash and let that number build up a little bit, right? Not distribute it to your personal checking like in this diagram, or you can just lend, right? You can buy it on margin with debt, and you don't really need to pool up more money in your account, right, for your business. Um, so I think people just, I mean, this is how we do it, right? Now, I'm earning 3.5% on that money that's in these like in this personal account, and I need that personal account because you and I are buying properties, right? And so we need to have money in that account to buy properties, attractive ones when we find them, right? We need to
Yep.
put the money in. Um, and then two, the banks, when we're getting loans to these properties, right? They need to see that cash in an account that's accessible. The one thing that I have not done in the last 3 years that when I look at these diagrams and I think, okay, what would my ideal piece be here? It's not bad to have a good chunk in equities, right? But not tax protected equities, right? Not your 401ks, not your
Yes.
IRAs. Those are
Yes.
good for other reasons. But when you're talking about liquidity, right, there's large penalties when you remove money from those, right? So having an equity account that's building value over time, that's taxable when you sell, but having that equity account it does two things. One is it, like I said, you're as a guarantor on loans, you can use that account, right? Because it's not tax protected, your equity account, like, 2 million in stock or whatever in index funds, the bank will count that as liquidity. So that's
Yep.
one nice thing when you're applying for loans. But then, two, it provides that buffer of, like you said, you can take a line of credit against that if you ever really needed cash, right? If something bad happened or you wanted to invest it, right? You could borrow off of that. And two, it's earning, long-term returns on stock markets like 8%, right? So it's earning higher than the 3%, right? And it adds diversity to your overall portfolio. So I do think that's a nice thing to have as well.
So, because then you basically think if your liquidity is 20, 30% of your portfolio, whatever it needs to be for you individually, you might have a blended return of 6 or 7%. If you have 2 million stock, a million cash, but it's in high yields and CDs, maybe that blended rate is 6, 7%, right? So that's the goal
Yeah.
is if you don't want to keep it all in cash, you don't want to keep it all in the stock market, right? Because that's a pain in the butt if you're
Yep.
always buying, selling. So that's how you get there. And I was just going to say on this, so when you start thinking about this framework, basically you could put a line of credit against your practices here, which I have, right? And I just talked to a dentist in our Facebook group, and he was just telling me that they'll loan up to like 80% right now. Like he could do like a cash out refi on his practice at 80% of his collections. And I was like, that's crazy.
Does he
So
have no loan on his practice?
I don't know. I'd have to ask more details
It
on
must
that.
be it must be debt free. I would imagine. Did he say
Well,
what
even
bank?
through a bank, and I think it was. No, was it Provide? I can't remember who he said it was, but
Yeah.
he's got very profitable practices. But it was just so to tie back that point is you have a line of credit that you have available. Like you don't need to draw on it, just apply and then renew it every year so you have it. Is kind of what my strategy or advice would be because it costs you like $600 a year to have that line of credit, even if you don't use it. So. I I have it on my practices, right? You can do it on your home. This after tax brokerage account right here, right? If I can get 30% on whatever the total value is in there. So if Josh's point, if you have $2 million in a brokerage account in index funds, you could probably get a $600,000 loan against it if you want. Not saying you should do it, but you probably can.
Y- Yeah, no, I mean usually for index, if it's index funds, it's not individual stocks, right? Index funds, like broad index funds, I guess,
Yeah.
like
You
a,
have to be
a total
diversified.
market one. Yeah, no, I usually see like 70%
Mhm.
is the amount that you could borrow against. So
You can go up that high. They just say, right, that the risk when you start going above 30, 40% is there's a good chance at some point. there's a market correction of 30% or more, but there's rules on that,
Right.
I guess.
Right,
So
right, 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 right.
yeah,
Yeah,
yeah.
totally.
So,
You don't want to expose yourself, but
but here's one thing I wanted to say on that though too is when I've looked at margin for the stock market, when I've looked at securities backed line of credit, they still don't have as favorable loan terms as real estate does, and what I've seen typically. And the other side of that is that typically stocks, even if you have the S&P 500 or whatever, usually only have like a 2% dividend. So cash flow off of stocks is pretty low if you ever wanted that to service your debt versus
yeah.
like real estate has higher cash flow. So it's more easy to service the debt. So if I have to choose between having a $10 million portfolio of stocks versus $10 million of paid for real estate and you want to borrow against it, real estate loan products, LTVs, cash flow tends to make more sense when I just think about it from that structure.
Yeah, I mean, I hear you. Those are valid points. What I've seen back in the days before interest rates started going up, let's talk like 2018. Okay. 2018, you could log into like your Fidelity account, your Charles Schwab account. You could borrow money with a click of a button at like 2.5%. If you had a big enough like stock account, let's say, I forget the number was, like 3 million or 5 million or more, you could literally just click of a button, borrow at 2.5% from that stock portfolio. Like
That's
so
great.
easy.
Yeah,
Um, so yeah, right now it's not like that. It's different. But the rates are actually quite competitive on especially IBKR, right? I mentioned that before. They're usually the lowest rates. So that's like investing for professionals. Picture like Fidelity or Charles Schwab for professionals is IBKR .com. So um
man, you should get some sponsorship with all these name drops. You've Meow,
well, I
Fidelity.
just like, how it takes it takes 10 hours to figure all this out or
Yeah,
3 hours or something. So if we can save people the time. Um, so yeah, I think we've covered it. I
Yep.
think we've
Yep.
covered our goals today. Reed, do you want to go back and just kind of summarize the main points here?
Yeah, I think it's basically in the macro picture, we believe interest rates are going to be coming down. And when they do, liquidity is going to flood the market and asset prices are going to go up, right? And right now, basically, our strategy is be ready with access to capital to jump on deals when we can. And that doesn't even mean have just access to capital. It also means have access to deals for us, that's real estate, right? So you don't want to be waiting until interest rates have dropped to now try to go find someone who has a deal or find a deal yourself. Like you have to live in that space and know who those people are, right? Either do it yourself, the three legs of the real estate stool, right? It's you have to be able to buy it, fund it, and operate it, right? And if you can do all three, great, you can do it yourself. If not, you need to find a strategic partner so that you're ready to pounce when things happen, when rates
And
drop.
and sometimes people are like, "Well, I don't have money now." Well, we put something under contract, right? Especially
Mhm.
land. You can tie up land for like 18 months under contract with extensions, right? So, like there's so much land in my area now where, hobbyist investors bought the land, got it through permitting, have it all designed, but then like the numbers didn't make sense to pull the trigger, right? And so they're just like trying to sell this stuff because they decide they don't want to be a hobbyist real estate person anymore. And I put this stuff under contract and I'm like, hey, this is a good price. I don't have to pay for architectural. I don't have to pay for engineering. Permits are there. I don't have to pay for that. It's like everything's just like right there for me. And sometimes I'm like, well, A and B need to happen before I can actually like make this a very profitable development, right? But if I put that stuff under contract, like now I hold it, I'm in control of it. And when these
Mm.
other things happen, now like we're good to go. And let me be more
That's
specific. I hate when people are esoteric. Like, I'll put these things under contract. I'm thinking about two pieces of land right now. Here are like the current like legislation items that are likely to pass, okay? One, in my area, we have something called parking to people, where if you if something's a parking lot and you build on it, turn it into housing, you don't need to pay sales tax. Okay, that's 9.1% in my area, right? 9.1% is a good profit margin, right? So
For
just
sure.
that alone is helpful. But what they've been discussing doing, and they'll probably do it, just this is how my state works. They discuss it, they release like initial bills, request feedback, and then they go to like vote on the final bill. It's like they're changing parking to people to like other buildings that are just not used anymore. If a building hasn't been used for 2 years, right? You can turn that into housing and not pay sales tax, right? Another one is like you can change things that are zoned for like office or commercial and use them for residential as well. You don't have to request a change in zoning. The
Hmm.
state is saying they can get zoned. So in my brain, I'm looking at all these properties that are in great locations that can be turned into housing, right? That
Yep.
fit these bills before these bills are passed, right? And I'm
Mhm.
saying I just lock these places up, right?
Mhm.
Same with interest rates, like we talked about. Interest rates will probably go down. On some
And,
of these, I'm applying for grants, whatnot. So
and you,
basically, lock it up, a low price.
Mhm.
Then the things happen that would make this a no-brainer from anybody, but no one else can do it because you already have the land locked up, right? Now
Mhm.
you can close on it and execute your plan.
Yeah, I think people don't understand that. And really, you're controlling the land with refundable earnest money down, right? You got to put some earnest money down, but it's not like you're getting a loan on this property, and so
It,
it's a cheap
usually,
way.
yeah, some people
It's a
yeah, 6 months, the money comes back to me, like my down payment, right? If I don't
Mhm.
close on it in 6 months. After 6 months, maybe that money goes hard, which means I'd have
Yeah,
to pay it to them. But I can do like another 3 months extension for a little bit more money, right? Another 3 months extension. So it's like you just mitigate your risk. You control the properties that you think are really good before these legislations come out. The last one I want to mention is the current bill going through the government right now. We'll talk, probably do a show on this pretty soon. The 21st Century Road to Housing Act. Most the headlines were like, hey, institutionals can't own more than 350 properties, right? That's the headline you're seeing, right? Institutionals have been bidding up home prices. No longer can you own more than 350 properties. Like that's the headline you see. But
yeah,
there's a lot of other things in this bill that are really going to help us. So I talked about not paying sales tax when I convert commercial buildings or parking lots into housing. What's in the bill right now is grants. So federal grants per unit, 20 to 80,000, right?
Mm.
So now I'm taking, and this is a bill that has been passed by one of the guys. Let's see here. It's been passed by the Senate. Okay. Now it needs to go to the House. Okay. So when I'm looking at like an empty building that can be converted into housing, right? In Washington State, I think I'm probably not going to have to pay sales tax, 9.1% return, right? Now I'm getting let's say it's not 20, let's say it's not 80, let's say it's somewhere in the middle, like a 50K per unit, right? Well, 50K per unit on my construction apartments usually is about a 20% of my project, right? So between these two items alone, I have a 29% profit margin,
yeah.
right?
Mhm.
And how do I protect that 29% profit margin? I go put stuff under contract, right? So when these things come to fruition this year, which it looks like they're going to come to fruition by before the end of the summer, I already have built-in 29% profit margins. That doesn't even count like normal profit margins as a competitive business, right? This
Yeah.
is just government incentive, like
That's
guaranteed profit
yeah.
margins.
That's not land basis. It's not operational efficiencies. It's not cap rate
Right.
arbitrage. It's just yeah.
Everyone
Yep.
else is running numbers that like, oh, I'm trying to get a 5% cash on cash return or an IRR of this or a rate of return on this. I'm like, yeah, take that and then add 29%, right? Like
Yep.
lock up this land.
Yeah. Basically, be ready. Always,
Be
that's why we're
ready.
always buying. Be ready. We're always buying, even if it doesn't seem like a good time to buy, because then when things turn, you're poised to buy. I mean,
You're ready to go.
you're
This is
ready to
this is
go.
the time.
Yeah.
So, all right.
Okay.
That
Sounds
was a great show today, Reed. We really gave we went from macro, like fundamental concepts, models that you can see, that you can keep in your brain, right? These are the core things that guide us. And then we talked about real actionable steps, both on liquidity and on the investment side, how we're like in real time using this information to create net worth and cash flow for ourselves and a sense of security. No stress. Life's too
yeah.
short for that. So good.
I'm good. Have a good weekend.
Have a good weekend. Thanks, Reed.
Thanks for joining us today. If you want to connect with us directly and keep the conversation going, join our private Facebook group. We'd love to have you in the discussion. If you want to see or listen to any of our other shows, you can find them on our YouTube channel by searching Dental Real Estate Partners. Or if you prefer to listen in podcast format, look for us on your favorite podcast app or streaming platform.
Content from Dental Real Estate Partners is for informational purposes only and should not be considered financial, legal, or investment advice. All investments carry risk. Past performance does not guarantee future results. Always consult a qualified professional. Dental Real Estate Partners is not responsible for outcomes from actions taken based on this content.